Good morning and welcome to the Planning Opportunities to Mitigate UK IHT webinar. I'm William Godsave, a Senior Financial Planner at Credo, and I'll be joined in the second half of this webinar by Harry Robson, a Director at LGBR Capital. I'm going to speak for around 10 minutes on the main ways to mitigate IHT, with a particular focus on business relief investing. And then Harry will go on and talk in more detail about the Credo AIM portfolio, which has recently been launched. Reducing IHT and passing assets down to the next generation is an area of increasing concern and importance for many clients, and comes up regularly in my client meetings over the last few years. With the freezing of the tax bands and the general expected increase in asset prices, it's no surprise, therefore, that the trend and forecast for IHT receipts continues to increase, as shown on the graph in the bottom left, which is by the ONS and OBR. At the same time, there are a myriad of rules, options and products associated with IHT and succession planning, and many clients find it difficult to navigate those rules and to find what's the best fit for them. There's therefore a huge opportunity to add value as an advisor, to work with clients, to hold their hand through that process and provide them with solutions to help them meet their needs in this area. Before we look at the most common ways of mitigating IHT, I just wanted to cover some of the basic rules in relation to IHT. So the basic nil rate band, so the amount that can be transferred tax-free, is $325,000 per person, and certain families, if they meet the criteria, can be eligible for an additional residence nil rate band in relation to their main residence, which is $175,000 per person. A typical family then put together can often transfer up to £1 million tax-free to their beneficiaries and to the next generation, and anything thereafter which is subject to inheritance tax, so certain things aren't, for example, some pensions, but anything that is within the estate for inheritance tax is usually subject to tax at 40%. If at least 10% of the net estate is gifted to charity on death, though, you may be eligible for a reduced rate of inheritance tax of 36%. I'm now going to cover the most common IHT planning strategies that we see and we advise clients on. And the first is direct gifting. So this is directly gifting assets from the individual to their beneficiaries. And this is often a very simple and very effective way of mitigating IHT, and is often the starting point for my conversations with clients. For most gifts which require a significant amount of value, you have to live for at least 7 years from the date of the gift to ensure that it's no longer in your estate. Though if you survive for at least 3 years, there is a tapering down of that 40% IHT between years 3 and 7. There are some exemptions available, albeit they're usually smaller, such as the annual 3,000 exemption and gifts out of surplus income, which are still worth considering, as you don't need to wait for that 7 years and they are immediately outside of your estate. The second option is life cover. So people take out life cover to provide their beneficiaries with a lump sum to help fund all or part of the IHT bill. And there's two main benefits of this. First of all, it provides liquidity and quickly, so the beneficiaries aren't scrambling around trying to find the funds to pay the IHT bill, or trying to sell assets perhaps at the wrong time, or illiquid assets where it's difficult to sell. And secondly, whilst it doesn't reduce the actual amount of IHT to be paid, it does help with the overall objective of passing as much assets to the next generation as possible by finding cash from outside of the estate to pay for that IHT bill. The third is charitable giving. Both during lifetime and on death can be very effective because the transfer is immediately exempt. You don't need to wait for that 7 years, and it reduces the amount of assets in your estate. If you give away a sufficient amount, you may also be eligible for that reduced 36% IHT rate on the remainder of your estate as well. Fourth is tax efficient investing, which is what we're going to speak in a bit more detail for the rest of this presentation. And there's various reliefs such as agricultural property relief for certain agricultural land and business relief for certain business assets, which can qualify for up to 100% relief. And finally, trust planning. So this is where individuals would like to start making gifts, would like to start that 7-year clock, but are not prepared to give assets directly to the next generation at this point in time. And that may be for a variety of reasons. They may not have decided exactly who they want the money to go to or how much and when, or it could be for asset protection purposes. They're worried that the beneficiaries they give it to may spend the money, or there may be issues around bankruptcy or divorce, and they really want a barrier and protection from that gift to allow them to make decisions or protections later in time. If we now move on and look at business relief investing, the basic principles. So certain assets, mostly they are unquoted trading companies on certain AIM listed shares, can qualify for up to 100% relief from IHT, as long as they've been owned for 2 years and at the date of death. It is just worth noting for those people who want to get into the technical weeds a little bit more detail, that the value of the business relief asset does still count towards the limit to qualify for the residence nil rate band. So that residence nil rate band I mentioned on slide 2, 175,000, it does taper away after your assets reach a certain level, and it's worth noting and remembering that these business relief assets do still count towards that limit. But when we look at business relief investing compared to the other options, there's 2 main benefits that I see. The first is you only need to hold the asset for 2 years to get that relief, whereas majority of the other strategies such as lifetime gifting and trust planning, you have to wait for 7 years to ensure that it's outside of your estate. And the second thing is the actual business relief asset itself is in the donor's name and is under their control, and they can, in theory, access those funds if they need to. So issues around flexibility, issues around potentially needing this money later on for care home fees or for other things is reduced significantly because you haven't actually given away that asset. But of course, you can't have your cake and eat it. And there are drawbacks around business relief investing, and each individual client's circumstance needs to be looked at to see whether it's suitable. For example, there may be liquidity concerns, there may be investment risk concerns, there may be investment performance issues. There are always drawbacks and benefits with all these solutions. But where I've seen it most common is 2 scenarios. First of all, is those elderly clients, or perhaps those clients who are not in good health, who really don't feel comfortable waiting for 7 years for their gifts to be outside of their estate. So I've had multiple conversations with clients over the last few months who are in their 80s or in their 90s, perhaps a little bit younger, but with serious health issues, where they just don't feel comfortable with having to survive 7 years. Whereas this 2-year window, whilst they understand there may be more volatility or maybe liquidity issues, makes it much more likely that it will be outside of their estate, and they're willing to take that risk to just survive 2 years to get the relief. And the second is for slightly larger families or higher net worth families with more complex affairs, where the business relief element forms a slice of their overall IHT plan. So they may already be doing some lifetime gifting, they may already have a trust or some life cover policy, but they still need another arm to their leg to do something slightly different and with different characteristics, different risk return profile, different features, and this forms a slice of that overall plan that fits nicely with everything else they're doing. I'm now just going to look at at a high level, the main options in the retail market for business relief investing, because it's important that you're aware of what's out there when you're having conversations with clients, even though you may prefer, for example, AIM portfolios or the unquoted business relief portfolios. Having a general awareness of what's out there will be much more beneficial when you're having these discussions with your clients. And there's 2 main categories, broad categories of business relief investing that we see in the retail market. The first is AIM portfolios. So these are portfolios of quoted AIM shares across a range of sectors, which are managed by specialist investment managers. There is the potential for significant volatility, but there's also potential for significant upside as well. And under normal market conditions, there shouldn't be any liquidity issues with that portfolio. The second are unquoted business relief portfolios. Again, these are usually managed by specialist managers specifically for people who want to mitigate IHT, but they don't hold quoted AIM shares, but they hold assets in businesses such as property lending, renewable energy, asset-backed lending. And again, it's designed to do the same thing. People put money in there to reduce IHT after 2 years. It's generally seen, these unquoted business relief, as sort of lower volatility, lower return option, but part of that is because they're not quoted, so you don't see the value going up and down, but they do try to sort of go into sectors with less volatility and more predictable cash flows. There is usually some liquidity and some option to sell the shares back to the provider, but the returns and the projected returns are usually much lower than the AIM portfolios. And there's no one right or wrong with either of these. Sometimes with my clients who want to put a lot of money in, we do a bit of both just to get a different risk return profile, a diversification of manager. Some of my clients, they prefer AIM portfolios because they like the idea of things which are quoted, some bigger businesses which they know, and some more certainty around the liquidity point. Before I hand over to Harry, who will talk in more detail about the Credo AIM portfolio and Unicorn, which is powering the AIM portfolio, I just wanted to give a brief introduction of the process we went through and why we chose Unicorn to sort of help us with this solution. We interviewed and analysed a wide range of managers and specialists in this area, looking at things like their track record, looking at their team, their philosophy, meeting their managers, and really deciding what is the best fit and what is going to give our clients the best chance of meeting their goals with the product. And we felt that Unicorn overall fit that bill, and we're very confident that they're going to deliver the research and the backing that we need to provide a really good quality product for our clients. I'm now going to hand over to Harry, who's going to talk a bit more detail on this area.
Thank you very much, Will. It's been a pleasure to speak to you this morning. My name's Harry. I'm the Tax Efficient Investment Director at LGBR Capital. LGBR Capital help Unicorn with the distribution of their long-only OICs and also their tax advantage products. So let's start from the very beginning. Who are Unicorn? Unicorn are specialist UK investors that have a bias towards small and mid-cap investing, as they believe that this is the best place for growth and alpha over the long term. The Unicorn Asset Management investment team look to back high-quality businesses and be on the shareholder register for the long term. They do this by building high-conviction portfolios within those areas and buying best-of-breed companies. Looking at the team is led by Chris Hutchinson, the investment director at Unicorn Asset Management, who has been there since the early 2000s. He's joined by 6 other investment professionals, including fund managers and investment analysts. They have a focus towards ESG, with Alex Game and Cordelia Tanai focusing on ESG within the firm. Now, looking at their heritage within investing in AIM companies, Unicorn run over £1 billion, and since launch in 2000, this continues to grow organically year on year. Expertise of AIM investing. They run over 341 million AUM within the AIM market. This means that Unicorn are able to get excellent corporate access within them among the top on AIM, but also have a great understanding of the bottom end of the AIM market as well. Unicorn love AIM for the characteristics that the companies show and believe that some of these companies are very much the market leaders of the future. An example of this life science business is Abcam, that Unicorn supported very early in its growth stage within the VCT. They first supported this business as just above 50 million market cap. Abcam is now over 2.7 billion and has unfortunately recently delisted from the AIM market, but for a very long period of time was the largest company on the market. Looking at the graph on the right, it's an important point to point out the investment case for these businesses. You'll notice that the UK Smaller Companies Fund, Growth, OBC, Income funds have a huge weighting towards AIM securities within the portfolio. Obviously, you'll be aware that these do not claim any tax benefits. Therefore, Unicorn believes so strongly within the investment case for these companies that they are more than welcome to hold them without the tax benefits. So this means when building the AIM IHT service upon launch in 2016, it's important actually to note that the AIM IHT service is one of our most recently launched products and was off the back of client demand. The clients were either holders of the AIM VCT or Unicorn long-only funds and saw Unicorn as specialists within the AIM investing area. Therefore, there was a request to launch the Unicorn AIM Inheritance Tax Service in 2016. And so Unicorn are in an excellent position to provide research to Credo within these areas. Now, let's flip it on its head and focus towards the bottom end of the market. Obviously, I've covered this in some detail that Unicorn do have an AIM VCT. It's important that they actually manage one of the largest and most successful AIM VCTs currently in the market. This means that Unicorn are very much at the forefront of those small companies that get added to the AIM market that are typically not profitable, so would not qualify for this type of scheme at that moment in time, as the baseline for these types of companies is profitability. However, what it does provide is Unicorn with an ability to see those companies that have just become profitable, that they've held within the AIM VCT for a number of years. There has been over 10 companies that have graduated from the VCT to an investment within the long-only funds or within the IHT schemes. And one of the reasons for this is that Unicorn will have been working with these companies for multiple years and have a great understanding of the management team, have worked closely with them in the past, and also have a great idea of where that company's going. So they have very much almost a first dibs at providing that follow-on capital within the market when it becomes apparent that it's able to be added to these types of portfolios. It's also important to look at the responsible investment angle. By getting in early with these businesses, Unicorn are able to embed and engage with these companies over the long term to provide an excellent ESG and also reporting principles for the company. So looking at a case study of this, Traxys, who are a leading provider of software, hardware, data analytics and services for rail traffic data and also wider transport industries. Why did Unicorn like this company to begin with? They have strong cash generation, resilient business model, they've got multiple growth sectors within large markets and also strong market fundamentals. So you'll notice in 2007, Unicorn first invested at IPO. This was at 40p, and obviously it's now gone on to return over 2,164% for the VCT. But as mentioned, Unicorn IHT was launched in 2016. Therefore, the investment was actually added into the AIM IHT portfolios at 500p, and has since then returned 85% for the IHT. But this is a great example of how a VCT company has taken a few years to mature and grow and has been able to be inputted into the IHT portfolio to return a good percentage for clients over the long term. Now moving away from a little bit about what Unicorn can provide and what the Credo AIM IHT service provides. So by leveraging Unicorn's research within the markets, within the AIM market, Credo are able to build 4 different distinct portfolio options. So you've got the growth portfolio, which focuses on market leaders, innovative disruptors that are exposed to long-term structural growth trends. Whereas the dividend focus has a portfolio of cash generative businesses with a target yield of 2 to 4% paid monthly. These dividend portfolios also have a large focus on those family-run businesses, which you see quite often on AIM. A great example of this is James Halstead, with a large percentage of the share capital still held by the Halstead family. But in addition to that, by having a rigorous, responsible process, Unicorn are able to provide the research for Credo to launch the responsible AIM inheritance tax focused portfolios as well. So now when you sat down with a client talking to them about what Credo can provide for your clients, they're able to provide a growth, a dividend, but also responsible options, meaning that you can take your client down that long-term path and find out exactly what they want. It's also important to note that this can be held within a Credo ISA or within a GIA. Now looking at some typical portfolio characteristics and where the Credo model is differentiated from others. Let's for a second focus on the FTSE AIM All Share, where 28% of the index is in 1 billion plus companies. And on the right hand side, you'll see the top 10 within the market. To preface this, Breeding Group are now leaving and becoming a premium listed business. Therefore, this will exit the FTSE top 10 holdings. However, Unicorn, you'll notice on the right, the ticks. Unicorn only hold 1 of the top 10 FTSE AIM index, and that is what will be added to the portfolios. Unicorn, as we discussed, find their better ideas within the small to mid cap range. Therefore, the 150 to 500 million range is typically where the portfolios are overweight, and you'll see 46% in growth and 43% in dividend. This is because they benefit from the research within the AIM VCT, but also the wider team prefer with the 150 to 500 area market, as they think over the long term, small caps and mid caps will outperform. Now looking into a little bit about the differences. As you can imagine, the 2 different portfolios look for slightly different metrics when adding, so you get slightly different characteristics on the back end. Typically, the dividend has lower volatility and tends to hold up better in market sell-offs. This is because it's got more of a natural orientation towards value investing. Whereas the growth portfolio, in the times where markets are good and growth is the focus, has tended to outperform significantly the dividend portfolio, but also the FTSE AIM All Share. So if you're looking for a more defensive portfolio, the dividend is certainly the one to look at. However, if you're looking for something more growth orientated, and typically the client might have a longer time horizon, then the growth portfolio is the correct one. Now, just to wrap up and talk a little bit about the Credo AIM IHT service. Obviously, as Will mentioned, Credo chose Unicorn to provide the research for this product, and we're very excited about this and excited going forwards. The service has 4 different distinct portfolio options: growth, dividend, and responsible investment. And this is powered by research done by Unicorn AIM, Unicorn Asset Management, who are specialists within the small and mid-cap and AIM market. They leverage the ability to look at the VCT companies from the very bottom, but also the long-only companies from the very top. Unicorn believe that AIM can provide some of the best opportunities for investors within the UK and are exposed to long-term structural growth trends within this area. On top of that, Credo also provides the flexibility for clients to access those 4 model portfolios within an ISA or direct. Please let me know if you have any questions, but it's been an absolute pleasure to speak to you this morning. Thank you very much for your time.